updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks are lower across the board. 43 minutes to go ahead of the closing bell. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks still in the red in a choppy session with the Dow down 29 points. S&P's dropped 9 and NASDAQ is off by 66. The U.S. 10-year yield at 3.75%. Gold is higher by 8. Oil is also trading higher. And Bitcoin is up by 1.4%. Among the main 11 S&P sectors, leaders were real estate and energy, while utilities and tech were under pressure. And leaders to the upside in the Dow Inc. and American Express, while Apple fell 2.4% and led to the downside. And regarding Apple, it fell intraday on a report that its iPhone 14 Pro and 14 Pro Max shipments in Q4 will be 15 to 20 million less than expected. In deal news, Boston Scientific to buy Apollo Endosurgery for $417 million. And in other news, Amazon kicked off its 5-part dollar bond sale. Wrapping things up, tech earnings tonight with CrowdStrike, HPE, Intuit, and Workday all reporting after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type Squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thanks so much, Charlie. Well, Goodwill Industries, you know them well, and I feel especially at this time of the year when you might be making some end-of-year donations. Goodwill, though, is busy throughout the year. Last year alone, serving nearly 2 million individuals around the globe, including helping to train more than nearly 125,000 individuals for careers in industries such as banking, IT, and healthcare. So a really appropriate guest and topic on this Giving Tuesday.
We've got Steve Preston with us. He's CEO of Goodwill Industries International. He's also got a great background. He worked in the government as administrator of the SBA. He was Secretary of Housing and Urban Development. Stephen, good to have you with us this afternoon. How are you?
I'm great. It's great to be with you guys.
Before we get to what exactly you're doing at Goodwill, I just want to get an idea of what you're seeing with the labor market, what you're seeing across the economy, because that directly impacts what you do at Goodwill. So what's your read?
Yeah, for sure it does. So our network employs 120,000 people, and as you mentioned, we support 2 million people on their quest to a better job each year. So we touch the labor market in a number of different ways. We're seeing what a lot of you all see. It is hot. It's a little bit less hot than it was a few months ago, but it's still from a historical perspective, really strong labor market. The other thing we're seeing, though, is the narrative here is less about the problem getting a job. The narrative is more around people being able to find the right kind of job and employers finding the right kind of employee. Increasingly, what employers have told us over the last 5 or 6 months is they've got these great jobs available, but they need people with the right kind of training to be able to be successful in them. And they're often jobs that are well-paying, offer good advancement, and good benefits. We have people on the other side who are sort of churning in low-wage jobs who told us that they want those better jobs, but they're not able to compete for them because they lack the skills or other support they need to be successful in them. And so we try to provide that bridge, but there's a huge opportunity out there right now in our market for people to move from lower wage jobs into better jobs if they can get support during that pathway.
Steve, I've got to say, I feel like over the years we've talked often about a skills gap. I feel like Alan Greenspan used to talk about it a lot when he was Fed chair. And so not a new idea, but I appreciate what you're saying. So how do we really significantly make sure that, the skills that are needed are being provided, whether it's through academic institutions or other types of training, facilities? How do we fix this problem that's been around for a while?
Yeah, it's been around and it's expanded and it's getting worse. So I'm glad you brought that up. I think foundationally, we need to make sure that young people are entering the labor force with foundational skills, whether they be digital skills, core mathematics, core, reading and writing skills. A lot of those are missing at the outset, and that's sort of the entry point. But
Is
what
that
we also
basic education, like through high school, are
think
you talking about?
Absolutely.
Yeah.
It's basic education in high school, and we need to make sure their educational institutions are preparing people for the workforce. And many of us believe providing more vocational opportunities for people who don't necessarily want to go to college, but are perfect candidates for great jobs in the trades or in other areas. When people get older, if they're unable to be successful in the labor market, or if they have other challenges in life, it is really hard for people to get back on track. And as a result, we need ways for those people to get the support they need so that they can not only break through barriers that they have in life in general, but they can get those core skills. We see single moms with kids in homeless shelters going to jobs at Google and Accenture in 6 months.
Wow.
Because they're getting support they need to kind of work through that journey, maybe
Right.
housing support or other support, and they're getting breakthrough digital skills or other skills. And the interesting thing about that is that first job isn't necessarily the ending point. It's like a destination where people say, oh my gosh, like I can do this. I've got these skills. And it changes the trajectory for people in their lives. So there are pathways. We see it every day in the work what we do, but we need people to get more access to those supports and not only the skills themselves, but help through that initial part of the journey so that they can get to the other end and move into employment.
Hey, Mike, we only got a minute left, but you worked in government for many years. You were former Secretary of Housing and Urban Development. You were administrator of the SBA. Given what you know now, from your work at Goodwill, if you could wave a magic wand and get lawmakers to do something to help alleviate the issues that you see each and every day, what would it be?
Well, first of all, my magic wand would say, let's agree there's a problem together and we want to work together rather than going into our separate camps. So that's a broader narrative. I think we need to focus on the core educational lack in this entire system, both at the secondary education level and beyond, because our employers need it, our people need it, our communities need it, and there are pathways both early on and throughout life that we can support that will change this issue. And I think there's a lot of data out there. There are a lot of service providers like us out there, and if we can come together, we can make a huge dent in this issue.
Well, we've run out of time, Steve, but I hope you will come back because we would love to continue the conversation, and I feel like there's a lot of other areas that we could go with you. Steve Preston, Chief Executive Officer, Goodwill Industries International. He's former Secretary of the U.S. Department of Housing and Urban Development and Administrator of the U.S. Small Business Administration. He served during the George W. Bush administration, so great to catch up with him via Zoom in Washington, D.C. A lot of relevant, when you look at our labor market and how tight it is, this is ways of creating workers that have the skills that are needed. This is Bloomberg Radio.
broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C., Bloomberg 99.1 to Boston, Bloomberg 106.1 to San Francisco, Bloomberg 960 to the country, Sirius XM Channel 119, and around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening and watching Bloomberg Business Week on this Tuesday. Coming up, we're going to talk a little bit about people that are maybe just weary of all of the tweets by Elon Musk.
He's been tweeting a lot, Carol.
Yeah, but he seems to be okay with it.
So he runs Tesla. You know, he's got SpaceX.
There's that
Someone else
boring
runs that,
company.
right? Boring company. There's a Neuralink as well. He's got Twitter as
Maybe
well.
going to create phones.
But what's the issue with what he does at Twitter?
Yeah.
And how does it affect Tesla?
All right, we're going to get into that in just a moment with our own Ed Ludlow. But first up, back to the markets and back to your top business stories. Charlie, just about 28 minutes to go.
Indeed, and we're in the red, losses across the board for the Dow, the S&P, and NASDAQ. Developing story, though, out of Twitter headquarters that we are monitoring. Elon Musk has told all Twitter employees who work on software projects to sit on his floor of the company's headquarters in San Francisco. This, according to Insider, citing an email reviewed by the media outlet and an unidentified person familiar with the company. That email said, quote, anyone writing software or doing design in the Bay Area should be on the 10th floor of SFHQ. It is intended to be dense and intense. Thanks, Elon. That's according to the memo. Again, developing story, and we'll have more details as they become available. Stocks lower ahead of Jay Powell's speech tomorrow. Yes, we got the speech for you live on Bloomberg Radio. Some of the world's largest tech companies leading losses today. Treasury yields are climbing. Let's begin there with the 10-year, 3.74%. The 2-year, 4.47%. Briefly, some of those tech names. Apple, case in point, down 2.5%. Microsoft down 0.7%. Amazon right now lower by 1.5%, and Google is lower by 0.7%. Spot gold up 0.5%, $17.49 the ounce. West Texas Intermediate crude up 1.5%, $78.43 a barrel. Unrest in China has been a concern for investors in recent sessions, both in terms of domestic demand and exports. Joanne Feeney is a partner at Advisors Capital Management.
Clearly, the risks have gone up for anything with a supply chain that's rooted in China. Well, we can see Apple making some changes, right? They're starting to position themselves to spread their manufacturing out across the world, India, Singapore, elsewhere, and other companies are doing the same.
And again, Apple shares, they're down now by 2.5%. AMC Networks, home of popular TV shows like The Walking Dead, have announced a layoff of 1/5 of its U.S. workforce, along with the departure of its CEO. AMC Networks shares down now by about 6%. Recapping stocks lower, S&P down 0.2. I'm Charlie Pellett. That is a Bloomberg Business Flash.
All right, appreciate that update, Charlie. This may not come as a surprise, but Elon Musk's Twitter is full of people swearing off buying Teslas. Maybe not a surprise.
We've got Ed Ludlow joining us. He's co-host of Bloomberg Technology for Bloomberg News. He's with us from the Bloomberg at 960 studio in San Francisco. It's time now for Plugged In on Bloomberg Business Week. It is your weekly look at EVs, brought to you by Audi. Don't let someone else drive off in the Audi model you've always wanted. Visit your local tri-state Audi dealer to get behind the wheel of yours today, or visit AudiOffers.com for more information.
So let's get to it, and let's bring in Ed. Ed, what's going on?
Well, I think you're right. You know, the headline is that if you go through Twitter, you will find some people, some accounts that purport to be Tesla owners or previous Tesla owners who love the vehicles or own the vehicles, but they have moved away from the brand because they don't agree with Elon Musk's ownership of Twitter, some of the things he has said on Twitter, or some of the policy actions he's made, right? For example, reinstating President Donald Trump to Twitter. That, you know, in some cases people reacted to it. I would say, we should be really clear, this is kind of largely anecdotal, right?
Yeah.
And there's some data we can go over where a number of factors are in play, but there is evidence that, you know, Tesla's not as dominant in the EV market as once it was, at least here in the US.
But is that a function of they were the first mover and they kind of, you know, helped create a category here in the US, and now you've got companies like Volkswagen, GM, and Ford literally throwing tens of billions of dollars at it to get cars out as soon as they can?
Yeah, so for a really long time, Tesla, I say really long time, I mean the Model 3 was the first kind of mass market electric vehicle which was mass produced starting in 2018. But for those 4 years, that was the volume EV that was available. Now, fast forward to the end of 2022, going into next year, there are 30 different battery electric cars here in North America that consumers can buy. They have choice. And even though EV penetration overall is single digits, low single digits, the share that Tesla's taking of that low single digits is kind of diminishing a little bit. Not because necessarily people hate Tesla all of a sudden, they just have more choice. And there's so many factors, like if you've always bought a Ford vehicle, it makes sense that you would buy an electric version of a Ford vehicle if that's the brand name you've always had in your driveway.
But I do wonder, Ed, for everybody, maybe you tick off a little bit. You might attract somebody who's like, yeah, I like this guy. I like the way he's kind of brash and he's out there and talking about freedom of speech and so on and so forth. So for everyone you might put off, you also attract some others.
Well, I'll give you a slightly parallel example. Elon Musk's challenge to Apple and Apple CEO Tim Cook in the last 24 hours.
We talked about this with Mark Gurman. Yeah, go ahead.
Well, so to recap, he kind of accused Apple of not supporting free speech, being anti-free speech. But there are a number of people that I've seen, again, this is anecdotal, that came out and said, yeah, we support Elon Musk in this. We disagree with Apple. And it shows you the influence that this man has, but also that the Twitter platform has around conversations about this, choosing a side. You know, one thing I want to make really clear about this story, and I encourage all of our global listeners to check it out on Bloomberg.com, on the Bloomberg terminal, a big part of it is based on this idea that if you do look at surveys of existing Tesla owners, one they choose is the 100X app, which surveys owners. You know, today, right now, there's a lower proportion of owners, around 65%, compared with 70% last year, that would say, yes, I'm going to buy a Tesla again, or yes, I'd recommend one. There are a number of factors at play at that. What we're saying with this story is that Elon Musk's recent activity around Twitter is a new factor, and it's certainly playing into the conversation.
Okay, Ed, before we let you go, about a minute left here. Elon Musk has long had his attention divided between many different companies, but something seems different, and maybe because we're seeing it play out in real time through reporting, but also on Twitter. It seems like he is almost singularly focused on Twitter right now. What does that mean for Tesla?
Yeah, so the Tesla shares have been under pressure for a while, right? And one concern is key man risk, that the future of Tesla is very closely tied to Elon Musk's involvement. He was honest the other day in a Delaware court hearing over his 2018 pay packet, which we can get into another time, that right now, yeah, he's super focused on Twitter, but he expected it to be short term before he goes back to focusing on Tesla, where he is the CEO, but by his own admission, he's not sort of the pencil-pushing CEO. He's the hands-on engineering CEO that's really focused on the products. And that's his promise, that he'll go back there. But there are many vocal parties saying, come on, get focused back on Tesla. Stop being so distracted by Twitter right now.
All right, going to leave it on that note. Hey, Ed, thank you so much. Ed Ludlow, co-anchor of Bloomberg Technology, joining us from our Bloomberg 960 studio in San Francisco. Tesla shares, by the way, they are down almost 49% here in 2022, and we're seeing some more selling in today's session, down about another 1.4%, and definitely off their highs that we've seen about a year and a half ago, I think it was.
It's been under serious pressure over the last 18 months. Let's get to world and national news. Nancy Lyons is in our D.C. newsroom. Hey, Nance.
Thanks, Tim. President Biden is pressing congressional leaders to pass a bill that would prevent a strike of the nation's freight railroads after several unions voted to reject a negotiated deal. Bloomberg's Irv Chapman has more on today's White House meeting.
Speaker Nancy Pelosi and Senate Leader Chuck Schumer spoke after the meeting.
Tomorrow morning, we will have a bill on the floor that accepts the original agreement plus the additional benefits that were gained in further discussions. We will bring up the legislation, send it over to the Senate.
And Leader McConnell and I agreed we'd try to get it done ASAP.
Republican leader Kevin McCarthy said he thought the bill would pass. It faces some opposition because the imposed agreement would not grant the workers paid sick leave. In Washington, Irv Chapman, Bloomberg Radio.
Lawmakers still have a defense spending bill to contend with in this lame duck session, and the Pentagon says there's still a pressing need for additional aid to Ukraine. The U.S. has already provided billions of anti-missile systems designed to deflect Russian attacks. Today, Pentagon spokesman Air Force Brigadier General Pat Ryder was asked if Patriot missiles are on the list.
Right now, we have no plans to provide Patriot batteries to Ukraine. But again, we'll continue to have those discussions, and when and if there's something to announce on that front, we will.
Ryder says they're also looking at what kind of help the Ukrainians need to repair damaged infrastructure. At the World Cup, Team USA is leading Iran 1-0 in a do-or-die game. England is beating Wales 3-0. Earlier today, the Netherlands beat Qatar and Senegal beat Ecuador. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much, Nancy Lyons. Carol Masser, my co-host Tim Stenovec here on Bloomberg Business Week, on Bloomberg Radio, on Quick Take, and on YouTube. This story by Shelley Hagan of Bloomberg News talks about a bill proposed by a Texas lawmaker that would prohibit businesses from receiving tax subsidies if they assist local employees in getting abortions outside the state.
Wow, we are seeing the consequences of the striking down of Roe v. Wade happen in real time. For the context here, we've seen many companies come out and say that in the wake of Roe v. Wade being struck down by the Supreme Court earlier this year, what companies are going to do is pay for abortions if women need to travel across state lines.
Help out their employees, right?
Exactly, provide them medical services. So now you have House Bill 787, which was filed last week ahead of the legislative session, offering it up by Republican State Representative Jared Patterson, represents a district in northern Dallas. Patterson didn't return a request for comment, but we should note that the state of Texas enacted an almost total ban on abortions in the wake of the Supreme Court ruling that overturned the federal right to the procedure.
Right. Previously had one of the most restrictive laws in the country, so even before that all-out ban. In March, Citigroup said it would cover costs for employees who need to travel out of state to get abortions, and companies, including Walmart and Apple, have put in place similar policies, really drawing the ire of lawmakers who see them as an attempt to circumvent Texas law. So, man, I mean, it's getting tougher, this fight.
Here's what I wonder.
What?
We've seen companies over the last 18 months move from California to Texas. And
a lot, right?
People as well. Yeah, I don't want to overstate it, but because a lot of it's been anecdotal. But Texas has been this welcoming place for companies, for corporations, and they've been trying to do that, at least, and I'm just wondering, that puts this at odds with what the state is trying to do in order to attract and retain talent in business.
Like, you do wonder about that, right? That's revenue.
Yeah.
That's tax revenue. That's just people living there, doing things, creating a certain velocity. But again, this is a struggle and battle that will continue to play itself out probably state by state. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We have got the Dow, the S&P, and NASDAQ all declining right now. Just about 13 minutes to go ahead of the closing bell. Gains in energy, industrial, financial firms all tempering a slide in big tech. Case in point, Amazon right now lower by 1.9%. Apple down by 2.4%. NASDAQ is tumbling 79 points, down 0.7%. The NASDAQ 100 index is now down by 0.9%. S&P lower by 11, a drop there of 0.3%, and the Dow ahead of tomorrow's speech by Fed Chair Jay Powell down 40, a drop there of 0.1%. 10-year yield 3.75%, with the 2-year yielding 4.48%. Spot gold up $7 the ounce now to $17.48, up by about 0.4%, and West Texas Intermediate crude up 1.5%, $78.43 a barrel. So a down day ahead of the close here. Recapping, S&P now lower by 9, down 0.2%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. President Joe Biden has often described his plan to cancel some federal student loan debts as a game changer. And in one sense, this policy has proved transformative, but by making a bad system worse. Biden's plan would provide $10,000 in relief to individual borrowers with annual incomes of $125,000 a year or less. But a federal appeals court recently ruled in favor of 6 Republican-led states that oppose loan forgiveness. So with its plans stalled, the administration has resorted to a fallback, extending a freeze on federal student loan payments, which has been in place since the start of the pandemic. It's difficult to overstate the folly of this decision. Freezing student loan payments made some sense during the early months of the pandemic, but there's no such justification now. Biden has decided to double down on a costly mistake. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg Opinion, please go to bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just got about 10 minutes left in today's trading session, counting down to the closing bell on this Tuesday. So let's talk about the markets before we head over to our TV colleagues to bring you down to the close. David Dietz is back with us.
He's managing principal and senior investment strategist at PPAC Private Wealth Management. They've got about $9.3 billion in assets under management. David joining us once again on the phone from Summit, New Jersey. David, how are you?
Doing well. Thank you.
Yeah, good to have you back with us. Hey, Carol and I were focusing on the slew of economic data that we're going to get this week. We're getting non-farm payrolls on Friday. We got JOLTS data on Wednesday. We're going to hear from Jay Powell tomorrow. What's front and center for you?
For me, it's Jay Powell speaking tomorrow. The title of his talk is going to be The Economy and Labor Markets. And the setup here reminds me a lot of just before Jackson Hole, where the market has had a nice stretch here since October. We're up at close to 12%. And, don't fight the Fed. The Fed is annoyed. Jay Powell's going to be annoyed because he's working so hard to try and get inflation down. And when risk assets start to rise, people start to spend. And that kind of defeats what his game plan really is. And so here, all bets now are on 50 basis points in December, but he may use tomorrow's talk to talk down, jawbone down that market and get people a little bit nervous. So it's a two-way street here on this stock market.
When you look at valuations, David, when it comes to the equity side of things, what are they priced for? Are they priced for a shallow recession? Are they priced for a deeper recession? Are they priced for what at this point?
Yeah, I think at best it's a shallow recession or not much of a recession. I mean, the good news, Carol, is we are down significantly in terms of the price-to-earnings ratio. It was around 23 at the start of the year. We got down to maybe a 15 handle, but since then we've drifted up to 17. So that's still much better than the start of the year. Here's the problem, Carol. We've got interest rates at 3.7% in the 10-year. A lot of corporates are yielding with a 5 handle. So your margin between your stock valuations and what you can get in the bond market, that isn't so juicy. And if earnings start to fade a little bit as the economy starts to weaken going into 2023, that's going to be a real headwind on the markets.
Hey, David, I think I've asked you this before, but it's been a couple months since I got to speak with you. As we think about the tumultuous and turbulent 2022 and what's ahead for 2023, at least for the equity market, is the worst behind us?
Yeah, well, trying to call a bottom is really a mugged game. Certainly in a lot of sectors, you got to believe that the risk reward is in your favor. Some of the semiconductor names, some of the technology names, they're down. Well, for example, Facebook, Meta, has lost $800 billion in market cap. Could it get worse? Of course it could, but it seems to me we're closer to the bottom than anything else. Different sectors of the market drop at different times. You've got over in China where the news is all bad, but nevertheless, large cap tech is up about 33% since October.
So David, you mentioned Meta. So buy Meta?
As part of a well-diversified portfolio, I love Meta. I mean, it's a unique property. They're reaching 2.5 billion consumers on the planet every month with, the Instagram and the Facebook and the Reels and the WhatsApp. And this is after they're down 800 billion market cap. So a value guy such as myself can finally buy it. It's 10 times free cash flow, trading at 13 times next year's earnings, very little debt. Now, the big problem is they're spending big bucks in the Meta.
Right.
First of all, I think longer term that will be successful, but they could always dial that
What's
back.
longer term, though? Like, are you saying that this could be a 10-year play before Meta really pays off, in terms of its banking on the metaverse?
So the fun thing about stock investing is stock investors bid things up as soon as they see a better stretch of road ahead. They don't wait till the end of the highway. And so I think as Zuckerberg dials back the spending on Meta, plus a combination just a little bit more of what this could ultimately do, I think investors will bring it back. I mean, this is a company that's down about 60% just in the last year. So it just has to get up 20% to make a worthwhile investment allocation.
Okay, David, give us some other names that you're bullish on.
I like Disney. Again, we're looking for world-class companies. They're down by.
Did you like Disney
half.
before Iger came back?
Quite frankly, I was disappointed with JPAC. I don't think he focused enough on the profitability. He did a great job in terms of acquiring more subscribers. They're now number one. They've surpassed Netflix in terms of these streaming subscribers. But the fact of the matter is Wall Street is in a different world now. Higher interest rates, they demand profitability now. He couldn't seem to put lipstick on that situation. I think Bob Iger is going to get with the program. He also has a way of keeping Wall Street.
But Bob's not necessarily backing away from streaming, so it's still the same course. He may do it obviously differently. They're different leaders. I mean, did you like Disney under Chapek when you were recommending it?
We're value players. So when it got to about 190 or 200, I said, no way. Once it drops below 100, I say there's going to be a catalyst somewhere which can take it back up. They've got the theme parks. They've got the number one position of streaming. They've got the world-class content. What's going to be the catalyst? I think Bob Iger coming back can get that done.
How much time do you give Iger? He's got a 2-year contract. I agree. Many would argue an incredible CEO based on what he did at the company and the performance. Investors seem to be pretty happy for a long time under his reign. How much time do you think it'll take to kind of right this ship? Especially in a world where I get the streaming play, but it's getting really crowded.
Yeah, exactly. But 2 years is a long time in this business. Actually, the one thing that's not spoken enough is that what he's got to get right, which he didn't get before, is getting a successor groom. Because you're right, he's not going to be there forever. He's got only that 2-year contract. So if he can get it on the right path, plus groom someone to take over, I think Wall Street's going to be really happy, and you can see that stock return to where it was, close to 200 over the next 5 years.
All right, before we let you go, 1 minute, 30 seconds, Amazon, make your case, down 50% from July highs of last year.
Well, e-commerce is here to stay. We saw on Black Friday that, record retail sales is up like 3%. How does that compare to inflation? Not well. But when you look at the e-commerce side of things, it's still going up double digit. Now, who's number one in e-commerce? That's Amazon, of course. And, of course, cloud. They're so far beyond their nearest competitor, Microsoft. And, the migration is just in the early innings there. So they got those two great businesses. Then, of course, they've got the subscription services, for example, Kindle, music, video, Amazon Prime. I think it's number one in everything they do. And as you just pointed out, you're buying it well off its highs.
All right, David Dietz, thank you so much over at PPAC Private Wealth Management on the phone from Summit, New Jersey. Just a few minutes left in today's trading session. It is time to head over to our TV colleagues and get to our cross-platform coverage of the market close. Radio, TV, YouTube, and Bloomberg Quick Take. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Scarlet Fu, counting you down to the closing bell, here to help take us beyond the bell. It's our global simulcast, and we're joined right now by Carol Master and Tim Stenovic. We welcome our audiences across Bloomberg Television, Radio, and YouTube. I'm not sure if you fell asleep a little bit earlier here, Carol, but this has been a pretty lazy session, if you will, in U.S. equity markets.
I just, I sit on the edge of every word that you have to say, Romaine.
I love it when you patronize.
Hard. No, it's interesting. I'm watching kind of the bounce off the lows, and I know some of our market coverage talking about maybe there's some expectation that Jay Powell will say something that will ease kind of some of the volatility that we're seeing in the market trade, certainly in today's session. Who knows? We'll see.
Does he have a track record of doing that? Because I thought it was kind of the opposite.
Well, it's so funny, right? We often get a Fed decision that the markets read one way, and then he comes out and does the press conference. Of course, it's not a decision tomorrow. It's just a speech. But, we'll see whether or not we get mixed signals from Jay Powell, guys.
Well, I just asked David Dietz, Managing Principal and Senior Investment Strategist over at PPAC Private Wealth Management, about everything happening this week. All the economic data we're getting, the JOLTS numbers tomorrow, non-farm payrolls on Friday. I said, what is the most important thing happening? And he said, Jay Powell's speech tomorrow, hands down. Is it going to be a repeat of what we saw at Jackson Hole?
Well, I think that's the fear. I think the hope is that maybe, yes, as Carol pointed out, that maybe he does signal that potential downshift. But I don't know. I guess I question the idea.
What indicates that he would think that?
Well,
nothing so far.
Well, I completely agree with you. I also am a little skeptical as to why he would want to communicate that before the actual meeting on the 14th, 13th, and 14th.
Yeah, that's a good point, right?
You know what I bet he's going to say? I bet he's going to say we're data dependent.
No! Well done, Scarlett.
If he does, Scar, you got to take a drink.
Yeah, absolutely.
All right, well, let's take a look at the data here for the broader market. Waiting for these numbers to settle, but basically it's an unchanged kind of day. The Dow Jones Industrial Average just poking into the green here at the close, up about a point. So you basically call that unchanged for the day. The S&P 500 down by about 0.2% or about 6.5 points, while the NASDAQ Composite lower by 0.6%. I thought it was interesting, though, that when you look for bright spots, the Russell 2000 was up 0.3%, the S&P mid-caps were up 0.3%, and Dow Transport's up 1.5% here on the day.
I got another one that actually showed some outperformance for you, Romaine, and we're talking about the KBW Bank Index. So those financials up more than 1% here. And, you have to think about the names that are gaining, whether it's energy, industrials, financials. What does that say, Scarlett? Is that banking on some kind of recovery ultimately in 2023 versus a recession?
It's hard to say, and of course, the view will change potentially tomorrow after Jay Powell speaks. For now, it's a real mix, a mixed bag when you look at the industry breakdown in the S&P 500. As Romaine mentioned, transportation is doing very well. The S&P Transportation Index rising more than 2% on the deal. Real estate investment trusts and energy have been doing well all day. Energy, of course, the best performer of the year, even as oil prices have lost their gains for the year of 2022. Banks also doing better, 1% gain there. And on the downside, side, we've got tech hardware and equipment, some of those big tech names, a drag on the indexes. We've seen Apple down, Microsoft down, Amazon lower, and retail is also losing ground, off by 1%.
I wish I could change my gainers list, but I can't. All right, I'm stuck to it. Let's get to some of those Chinese names that trade in the United States, because that really was top among the NASDAQ 100. JD.com among them, up more than 9% at its highs today, finishing the day with about a 6.7% gain. We know the story. There's expectation. We're starting to see some move among Chinese officials, maybe easing off some of those COVID zero policies, specifically speeding up COVID shots for the elderly. So maybe they are easing off COVID zero. Maybe that would be good for the Chinese economy. Let's wait and see longer term how this plays out. But nonetheless, we continue to see those Chinese names really popping in the last couple of days. Ralph Lauren also some outperformance in a big way, up more than 4% in today's session. It was top in the S&P 500. JP Morgan upping its price target to 132 a share. Stock closing at 112 and change today, upping that price target to 132 from 127, maintaining its overweight. Keep in mind, though, about 11% of the float is shorted. The recent second quarter, that company did have a beat. Revenue in China was up 30% during that last quarter, despite about 1/3 of its stores being closed. So really defying some of the Chinese retail weakness that we've seen as of late. Just some backstory there. And Catalent, this was among the outperformers in the S&P 500 earlier on. It was up as much as 4.6% by the close, just about a 0.6% gain. It's a maker of COVID vaccines for Moderna and J&J. It was up, though, earlier after Barclays analyst said an FDA overhang was removed. This had to do at some of the company facilities and concerns about safety production issues, but it seems like that is over, and so we did see that stock pop earlier in today's trade, Tim.
Okay, let's look at some of the decliners today. On the other end of the S&P 500, weighing it down, Apple, the worst performer on a point basis today, down more than 2%. It fell after TF International Securities analyst Ming-Chi Kuo, who has just a great track record when it comes to understanding Apple hardware, warned of significant downside risks to Apple and its iPhone supply chain due to those labor protests in China. He says that the iPhone 14 Pro and 14 Pro Max shipments in the fourth quarter will be 15 to 20 million fewer than expected, the analyst said on Twitter. So that's the current quarter right now. So fourth quarter, by year, but Apple's first fiscal quarter, I should note. Amazon shares down 1.6%. Keeping an eye on the company. The company's selling $8.25 billion of investment-grade bonds today. Should note that Amazon has shed half its value since July of 2021. AMC Networks, here's an interesting one, down 5.3% today. The company's saying that it's going to lay off 1/5 of its U.S. workforce. We're talking about the network behind shows like The Walking Dead and more. Also, the surprise departure of the company's CEO, Christina Spade. She was on the job for just 3 months. Shares falling 5.3%.
Yeah, it makes you wonder what was going on there behind the scenes over the last 3 months here. A quick check here on what's been going on in the debt markets. Also a relatively quiet day there. You did see a little bit of a spike in yields of 4.5% right now on the 2-year yield, not far off from basically where it's been pinned. Of course, the big story of the day has been that average yield on sovereign debt globally. Sovereign debt maturing in 10 years versus shorter term debt. That global inversion now back in swing. Remember, we did see a global inversion maybe about a year or so ago, but that did not last for more than a few days. This looks like it has a little bit more staying power and could have some broader implications here going forward for the broader implications about what we're pricing in when it comes to recession. Real quickly, guys, I do want to bring you a couple of earnings. We are getting NetApp earnings right now after the bell, the big storage data provider here. Apparently revising their forecast slightly lower here. Their 2Q numbers basically did beat, but guidance for the full year, particularly when it comes to revenue, looks like it's going to be a little bit light. Fiscal 3Q net revenue, 1.53 to 1.68. The consensus was for about 1.7. The other numbers pretty much following a similar trajectory. Those shares were down almost about 12% at one point here in after hours trading, Carol.
Yeah, and so, when you talk about the outlook, obviously plays into the tech space, and this is something that we've all been a little sensitive about, especially when we continue to see job cuts, but really that forecast is certainly what's disappointing investors. On the flip side, Workday, we see coming out, and it is up about 3.7% here in the after hours, and that company coming out specifically and boosting its fiscal year 23, adjusted operating margin forecast to 19.2%. Also, this always catches our attention, announces a $500 million share buyback. We see companies continue to do buybacks in this environment. Third quarter revenue was $1.6 billion. That was a slight beat. Third quarter adjusted EPS, 99 cents. So that was 15 cents better than what the street was forecasting, up 3.5% here.
I look to the commentary that we get from Workday, the company's co-CEO and chairman saying that there's no question about the current macro environment presents increased uncertainty, but the company did come out and say that because of the employees and continued innovation, we're confident in the long-term opportunity. This is a company that works closely with many big companies to get a good understanding of what's happening in the macro environment.
A lot of other earnings crossing the wire that we do need to get to. HPE shares higher here in the post-market. That 4Q number coming in, the fiscal 4Q number, did beat $7.9 billion on a rough basis here. Consensus estimate, Scarlett, was for about $7.4 billion. The guidance going forward looks pretty good. Range for first quarter adjusted EPS of 50 to 58 cents. Street was looking for 49, Scarlett.
We're also looking at Intuit. The software company is cutting its full-year revenue forecast. It also missed analyst estimates. So we're looking at the stock down about 1.7% for the quarter, or excuse me, in after-hours trading. I'm getting all my words mixed up here. Second quarter revenue sees a gain of 8% to 9%, and second quarter adjusted EPS of 141 to 145, far below the consensus estimate of more than $2.
All right, so, and let's get to Foot Locker, because also, man, stuff happening. The company's CFO, Andrew Page, to step down post the fourth quarter earnings report here. So this is just coming down as we see. And I'm just taking a quick look. Hang on. I want to look at the stock. It's unchanged.
The stock's up about 2.6% here in after-hours trading. We should point out, this is a big deal. Andrew Page took over, of course, maybe about a year and a half ago. It was in 2021. So kind of interesting. We don't quite have a reason why he's leaving, but once again, a relatively short tenure for another executive, this one at Foot Locker.
Yeah, the press release just saying, announcing some leadership change. So we'll look for some more analysis on that one. All right, guys, that's a wrap. Some earnings news, some corporate news, but that's a wrap on this Tuesday. Our cross-platform coverage, Beyond the Bell, radio, TV, YouTube, and Bloomberg Quick Take. We'll catch you again, same time, same place, tomorrow.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, so a lot of stuff happening in the after hours, including HPE, right? That's Hewlett-Packard Enterprises. We just want to point out that stock continuing to trade about 3% higher in the after hours. And the big reason why is the first quarter net revenue forecast, $7.2 to $7.6 billion. That beats the estimate that's out there on the street of $7 billion. You also had Workday, right, with announcing a bit of a buyback there. So some news coming out of that company as well. And we saw that stock moving around.
Back to these leadership changes at Foot Locker, I've been digging into a little bit, Carol. We're seeing that Frank Bracken has been named EVP and Chief Commercial Officer effective December 1st. Elliot Rogers is joining the company as Executive Vice President and Chief Operations Officer. And Andrew Page, again, transitioning out of his role as CFO following the company's fourth quarter 2022 earnings report. This says to pursue other opportunities. The company is saying that it's initiating a comprehensive search with the assistance of an executive recruiting firm to identify his successor.
All right, let's get back to World and National News. Nancy Lyons in D.C. Hey, Nance.
Thanks, Carol. President Joe Biden is urging lawmakers to pass legislation to prevent a freight rail strike. He is a staunch union supporter, but says a strike could cripple the U.S. economy. House Speaker Nancy Pelosi is promising a vote on a negotiated deal tomorrow. Also, during a meeting at the White House today, Biden emphasized the importance of approving a bill to keep the government running. Bloomberg's Jack Fitzpatrick has more on that.
Speaker Pelosi has said we may need a stopgap for the full year, meaning no increases for the military or anything else for the rest of the fiscal year. Kevin McCarthy is saying we could kick it into January and let a new House Republican majority take a shot at it. But they are going to take this probably right up to around Christmas before they even entirely figure out what the backup plan is on government funding.
Again, Bloomberg's Jack Fitzpatrick. Senate Minority Leader Mitch McConnell says there is no room in the Republican Party for anti-Semitism or white supremacy.
Anyone meeting with people advocating that point of view are highly unlikely to ever be elected president of the United States.
Senator McConnell's comments come as former President Trump is facing backlash for having dinner with rapper Kanye West and white nationalist Nick Fuentes at his Mar-a-Lago estate in Florida last week. Former Vice President Mike Pence has also criticized Trump for hosting those men. At the World Cup today, the Team USA needed a win or the players would go home. They did it. The U.S. beat Iran 1-0 and advances. England defeated Wales 3-0. Senegal beat Ecuador, and the Netherlands defeated Qatar. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Nancy Lyons in our DC newsroom. So this was an interesting story that caught Tim and my attention, and this comes from Jill Shaw and Claire Ruckin. Banks in the U.S. and Europe with about $42 billion of buyout debt stuck on their balance sheets are making the most of their last chance to get rid of it this year. So we're talking about stabilization. The leveraged loan and high-yield bond markets has led to an opening for deals, and that includes for bonds and loans tied to the buyout of TV ratings business Nielsen Holdings, as banks try to reduce debt on their balance sheets before the holidays. Offloading the so-called hung debt, even at steep discounts, confines losses to this financial year while also appeasing risk departments and regulators. I think that's a bigger thing, because you just don't know what might happen in 2023.
Well, speaking of that, there may be more to follow. A group of lenders, including Goldman Sachs Group, is nearing an agreement to sell $1.56 billion worth of a junk loan backing the buyout of Unilever's tea business, while other deals could also come before the end of the year.
Yeah, this is kind of interesting. And this, again, gets to, what everyone is anticipating for 2023. And I feel like at this point, we get some mixed views, whether it's from guests on air. I feel like the Fed speakers, there's a certain kind of drum that's being pounded at this point. Hung debt, though, has been a big problem for Wall Street this year. Banks have taken huge mark-to-market losses on deals that they underwrote before a rapid rise in interest rates crushed funding markets, and the threat of recession quashed investor demand for riskier assets. With that backdrop, stabilization of leveraged loan prices, which recently recovered to an average of close to 93 cents on the dollar in the U.S., according to index data, has created a fertile ground for deals. So when you see an opening, right, you go do them.
Yeah, it brings the total amount of debt funded by banks for buyouts and acquisitions in the U.S. and Europe to around $42 billion. That's according to data that's been compiled by Bloomberg.
And it's always good to just follow what's going on in the lending market, what's going on in the various credit markets, to get an idea of the healthiness, if you will, of the financial system and the credit system. Certainly something the Fed, we know, does also keep a watch on. All right, you're listening and watching Bloomberg Business Week. Carol Massar, Tim Stanovic, and this is Bloomberg Radio.
Bloomberg. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. 106.1. events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Several Silicon Valley companies out with earnings. CrowdStrike Holdings, the cybersecurity company, forecast revenue for the fourth quarter, and that guidance missed the average analyst estimate. After hours right now, we've got CrowdStrike plunging by 17%. Software maker Intuit has cut its revenue guidance for the full year. That guidance missed average analyst estimate, with the stock down after hours by about 2.2%. HPE, Hewlett-Packard Enterprise, projected revenue for the current quarter that beat analyst expectations. Hewlett-Packard Enterprise after hours up by about 2.9%. Also reporting after the close of trading, we heard from Workday. It's out with adjusted EPS for the third quarter that did beat the average analyst estimate. Turned out to be an up day for the Dow Jones Industrial Average, eking out a 3-point gain today, up by less than 0.1%. S&P, though, down 6, a drop there of 0.2%. Nasdaq down 65, a decline there of 0.6%. Stocks paired most of their losses, with traders unwilling to make big bets ahead of Jay Powell's speech tomorrow. Yes, we will have that for you live right here on Bloomberg Radio. 10-year yield 3.74%, the 2-year 4.47%. Spot gold $17.49 the ounce, up by about 0.5%. Bitcoin up 1.8%, 16,482 on Bitcoin. And West Texas Intermediate crude gained 1.8%, 78.64 a barrel. So again, recapping, stocks finished mixed. Off-session lows on the S&P down by 6 points. That was a gain of about, that was a loss of about 0.2%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, as we mentioned earlier, it is Giving Tuesday, a day that encourages people to give back in whatever ways they can. And our next guest certainly has some thoughts on that, especially when it comes to social philanthropy. Let's bring in Soraya Alexander.
COO of GoFundMe, you know it as a crowdfunding platform. Also the president of Classy. Soraya joins us via Zoom from San Diego this afternoon. Soraya, how are you?
I'm great. Thanks for having me.
Well, thanks so much for joining us. It is Giving Tuesday, and just give us an idea of what that means across the platform, because I don't actually see GoFundMe as seasonal by any means.
It's absolutely not. You're exactly right. GoFundMe actually is much more around individual needs, and as we know, those happen kind of any time throughout the year. It's much more on the Classy side. You mentioned that that division actually focuses only on nonprofits, and so several thousand customers of all sizes, and it's a huge day for the nonprofit sector specifically. We see 10 times the volume of an average day on this day alone, and it's a huge avenue to acquire new donors, and so it's a big day for the sector and for what it means for their programming for the year to come.
You're a busy person. Chief Operating Officer at GoFundMe, president of the online giving platform Classy. They have raised about $4 billion for social causes. I think some $17 billion on GoFundMe. What are the interesting things that we are seeing, Soraya, when it comes to people giving back, helping out others, helping different causes? And I do wonder if you're seeing any signs in the giving trends that show that maybe there's some nervousness about the economy, and so maybe some of that funding, if you will, or giving back is slowing down.
It's something that we are talking about a lot and paying attention to a lot. The really fascinating thing that we are seeing from our donors, and we do quite a bit of analysis across platforms in terms of giving behavior, but we also do a lot of surveys with the general public to get their sentiment. And the thing that we're finding is, yes, people are very pessimistic about the economy. They're very worried about their own financial situation. And yet, when they are thinking about how to categorize their spend and where to pull back, where to delay, where to downgrade from, let's say, brand names to generic brands, they're actually categorizing giving as a critical spend item. So they are seeing increasing need in their own lives and increasing need in society, and they're actually leaning into that. And so despite this pessimism and this nervousness, maybe because of it, people are actually declaring that they're going to give more, and they're really leaning into that. So we have seen really strong giving trends over time, and we actually saw this when COVID hit as well. The sentiment across the country was one of immense unease. And yet we saw charitable giving really spike through that time because people said, I know kind of the situation that my community is in, and I think I can respond to that need. So it's been really fascinating. There are some changes that we're seeing the last few seasons that I'm happy to talk about.
Yeah, talk a little bit about that, because I'm curious in the changing way that people think about this stuff. And I'm also curious about, like, and I don't mean to ask this question in like a way of, how to game the system, but I got to tell you, sometimes I'll see a GoFundMe that is just totally going viral. They've raised so much beyond what their goals are. And then I see others, that my friends post on Instagram, for example, and they're having trouble raising over $1,000.
Yeah, no, it's a good point. The GoFundMe kind of platform is really, we kind of help everybody become a fundraiser in their times of need, or whenever people feel like they've got an opportunity to raise for something. It can be aspirational as well. We have a lot of those kinds of fundraisers who do really incredible work. But really, a lot of what we are trying to do is help people become great first-time fundraisers. Fundraising is very difficult. You have to be able to continually ask people, ask your networks, go outside of your immediate friends and family, get your friends and family activated on your behalf, and some things capture the public interest in really incredible ways. And so we are constantly trying to help individual fundraisers navigate that kind of complicated landscape, and some do it really well. And for those who don't, we're constantly trying to figure out how we can better support them. But we also take a lot of lessons, again, from the Classy side, which supports nonprofits. And one of the things that we are seeing is people think about giving in all of these non-traditional ways. And so when we think charitable giving, you think of the nonprofit sector. And historically, especially in America, people are incredibly generous, but through these very formal giving structures and formal institutions in the nonprofit space. And as time goes on and people have financial challenges, and yet they want to give more, they're finding different avenues where they can really connect. And that might be non-financial giving. It's often giving to individuals, not traditional nonprofits. It's giving kind of time, attention, their own platforms as an elevation point. And so we're seeing this expanded definition of giving, but then we're also seeing these incredible links where the GoFundMe platforms, these individual acute moments for giving, can actually translate to long-term sustaining relationships for nonprofits. So that link has been really interesting to watch and actually help build out as well.
Okay. Well, so great to check in with you, and so appropriate, as we said, on this Giving Tuesday. Soraya Alexander, CEO of GoFundMe, president of Classy, joining us via Zoom from San Diego. You are listening and watching Bloomberg Business Week. Carol Master, Tim Stanovic will be back in just a moment. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening and watching Bloomberg Business Week on this Tuesday. Carol Master, Tim Stenovic. We're going to check in with our Ben Steverman, who's got another great story. It's a most read on the Bloomberg today. And it
Can I give a hint? Oh, you're going to talk about it.
No,
okay.
you go.
All right, well, if it's Ben Steverman, you know it's about a way that the ultra-wealthy are successfully avoiding taxes.
Yeah.
Well, you know.
Another tool.
Yeah, another tool.
Okay, we're going to get into that in just a moment. First up, though, a lot of news after the closing bell. Let's get back to Charlie Pellet, who's on it.
You're absolutely right about that. I've got you covered. Lots going on, as you say, Carol. CrowdStrike sinking and extended trading after the cybersecurity company issued a revenue outlook for the fourth quarter that trailed the average analyst estimate. CEO George Kurtz also said total new annual recurring revenue was below the company's expectations amid increased macroeconomic headwinds. Stock right now plunging by just about 19%. The software maker Intuit has cut its revenue guidance for the full year. That guidance missed the average analyst estimate. After hours, the stock is down by roughly 2%. HPE, Hewlett-Packard Enterprise, is projecting revenue for the current quarter that beat analyst expectations. Shares are up by about 2.9% after hours. Turned out to be a mixed day on Wall Street today, with the Dow Jones Industrial Average eking out a 3-point gain. A down day today for the S&P 500 index, falling 6 points, a drop there of about 0.2%. The Nasdaq Composite Index down 65, a decline of 0.6%. Nasdaq 100 Index lower by about 0.7%. Raising the question, have we hit a bottom for the U.S. stock market? That question for David Dietz, Senior Portfolio Strategist at PPAC Private Wealth Management, who is our guest right here on Bloomberg Business Week.
You know, trying to call a bottom is really a mug's game. Certainly in a lot of sectors, you got to believe that the risk reward is in your favor. Some of the semiconductor names, some of the technology names, they're down. Well, for example, Facebook, Meta, has lost $800 billion in market cap. Could it get worse? Of course it could, but it seems to me we're closer to the bottom than anything else.
He mentioned Meta Platforms now on a tough day for a lot of tech names. Meta Platforms had a gain of 0.6%. Again, after our earnings, CrowdStrike plunging, that stock down now by 18.5%. 10-year yield 3.74%. Spot gold up 0.5%, 17.49 the ounce. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, appreciate that update. As we mentioned, this is a most read story in the Bloomberg about how the likes of Ray Dalio and the Koch family have pioneered a powerful tool to give their fortunes away, which is appropriate because it's Giving Tuesday.
Oh, Carol, look what you did there. Ben Steverman is personal finance editor for Bloomberg News. He's with us right now in the Bloomberg Interactive Broker Studio. I did not make the connection to Giving Tuesday. That's not at all.
Yeah, that's why we put it out today.
Oh,
yeah,
really?
Yeah.
Oh,
yeah,
wow, that's so
yeah.
interesting.
Hey, Tim, welcome to the world of news.
Wow.
For news
Okay,
pegs.
fine. News pegs. Everything we're doing today.
It's
is
also
Giving
in
Tuesday,
Business
I
Week
guess.
magazine next weekend, but
Oh,
yeah,
it is.
yeah.
Great.
But
Okay,
this
so-
is a Giving Tuesday story for the ultra wealthy.
Okay,
as
there we
As
go.
you noted, it's like
A 501c4. What is that?
Well, it's this category that is, so you may be familiar with the 501c3, which is what you're
Just a nonprofit.
Yeah, just a regular nonprofit. When you give to a 501c3, you get a tax deduction. You can hold it against your income. A C4 is a ton of other categories of nonprofits, from low-income housing developers to Rotary International and membership organizations, AARP. Basically, it's kind of the dumping ground of nonprofits, and it's also been used maybe in the last decade or so as a political giving tool because it can lobby, unlimited lobbying, which C3s can't do, and then it can also give to campaigns, a large amount to campaigns. But what's new is that these things are being used to hold private companies and private assets that you couldn't put in a private foundation. So this is like a cutting-edge technique that billionaires are using to kind of unlock some of their wealth that they have. for philanthropy without say selling the company that they own and they built, and that's very important to somebody like the Patagonia founder.
That's what I was just going to say.
Who used this thing.
Okay, so this is what the Patagonia founder Yvon Chouinard did.
Yeah, and when he did that, I was like, oh, this is an interesting technique. I've never really heard of this. And then I went and looked through the filings, and I found, oh my gosh, this is something that Ray Dalio is using, and the Koch family is using. And it's sort of been something that's sort of been building under the radar for the last few years among very, very cutting-edge advisors. And there's real reason to think that it's going to go mainstream.
Help me understand, though, how it gives them the ability to exert influence. You're saying it's a tax break, but they could still have sway over politicians?
Yeah, so if well, it's a tax break because you don't get a deduction for putting something in these things, but you do avoid estate taxes and gift taxes, which is very important.
Right.
And also you avoid capital gains taxes. So if you put something in there and then it generates income, you don't have to. But then the reason it doesn't have the same rules against political spending that regular charities do and foundations do. Foundations have very strict rules about engaging in politics.
Right. It sounds like a miracle.
Yeah, no, it's kind of the have your what is
kind
it?
Of
Eat your cake and have it too, or whatever that phrase
have
is.
Have your cake and eat it too. Like
yeah.
No, it does. It feels like it checks all the boxes of giving them the tax advantages, but giving them an awful lot of control.
Yeah, and it all comes out of like a law that was very obscure law change that was made in 2015.
No, an obscure law.
Yeah, but then like 3 years later, people started to think about it, and they're like, oh wait, we can do something with this. And it's just, I think it's going to build from here. I think people are going to embrace this.
Does society benefit in any way?
Okay, so if you put assets in these things, you can't take the money back. Okay. There's no rule that it actually has to go out to charity on any regular schedule. Like a foundation, you kind of have to give about 5% a year to charity. There's no requirement that it goes to charity, but I mean,
wait. So where does it go then?
It's just going to sit in this thing. It could sit in these things for a long time.
Yeah, you should see Carol's face right now. You can log in on YouTube and watch us on Quick Take. She's just kind of blown away here. Again, the lawyers getting paid in all this. Hey Ben, could this work for family businesses too?
I mean, it's really kind of perfect for a family business. So you avoid taxes estate taxes on this business, but then you don't you basically unlock that money for philanthropy, but then you can also kind of maybe keep a slice of it and control the operations of the company, which is very important for somebody who founded a business, cares about it, doesn't want to let go of it, doesn't want to sell it off to the highest bidder and then have them come in and gut it.
This is not tax advice. Talk to your accountant, of course.
So is there bottom line, if you, based on your reporting, and just got about 20 seconds, I mean, the motive for doing this is X?
The motive we've talked about a bunch of motives, but one other motive is avoiding disclosure. It's easier to hide what you're doing if you set one of these things up, and there's some techniques that people are developing to do that as well.
And the three of us are all like tapping into this, right?
Yeah, not at all.
Ben Steverman, thank you. As we said, it's a must-read story, really interesting in terms of what's going on. Personal finance editor, all legal. Just going to put that out there at Bloomberg News, Bloomberg Interactive Broker Studio, joining us on this Tuesday.
Let's get to Nancy Lyon. She's standing by in Washington, D.C. for World and National News. Hey, Nance.
Thanks, Tim. President Biden is moving to prevent a strike that would shut down the nation's freight railroads. House Speaker Nancy Pelosi says the House will take up legislation tomorrow to impose a labor settlement despite the objections of some unions. The president emphasized the need for a deal while he met with congressional leaders earlier today.
There's a lot to do, including resolving the train strike and what we're doing now. And Congress, I think, has to act to prevent it. It's not an easy call, but I think we have to do it. The economy's at risk.
The president is a staunch union backer who has previously argued against congressional intervention in railway labor disputes. Well, Twitter says it is no longer enforcing a policy to suppress false or misleading information about COVID-19.
A note on Twitter's website says it stopped enforcing the rule last Wednesday. It's part of new owner Elon Musk's push to remake the social network as a platform for unmoderated speech. More than 11,000 accounts were suspended, more than 97,000 misleading posts removed since Twitter introduced the COVID policy in January of 2020. Now, without the rule, Twitter will no longer label posts that contain falsehoods about the virus or include corrections, and it apparently won't remove inaccurate tweets or ban accounts either. In Washington, I'm Nathan Hager, Bloomberg Bloomberg Radio.
At the World Cup, the U.S. has advanced to the knockout rounds of the World Cup with a 1-0 win over Iran. It was a politically charged rematch of their famous meeting a quarter century ago. The Americans will now play the Netherlands on Saturday at 9 a.m. Wall Street time with the chance to reach the quarterfinals for the first time since 2002. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. So we want to bring you a story. We are obviously continuing to follow the FTX collapse and just kind of the contagion. The fallout from the collapse of Sam Bankman-Fried's FTX crypto empire has spread to a new corner of the digital asset market. Traders' focus has turned to the price disparity between Bitcoin and a derivative of the largest cryptocurrency called wrapped Bitcoin.
Of course.
Which can be used on the rival Ethereum blockchain. Wrapped Bitcoin is backed 1-to-1 by the token, which is held in custody by the digital trust firm BitGo. While it normally trades on par with Bitcoin, a persistent discount emerged in mid-November, according to blockchain data firm Keiko.
Clear as mud.
So not parity then.
No, not parity. Wrapped Bitcoin, which is ranked as the number 23 cryptocurrency by total market value, gained popularity during the peak of the decentralized finance, DeFi boom. The version provides Bitcoin holders an easy way to trade, buy, and sell these tokens in DeFi. The Bloomberg Galaxy Crypto Index has tumbled more than 25% since Binance chief Changpeng Zhao, also known as CZ, raised concern about FTX just 3 weeks. That was 3 weeks ago?
I know, it's
Time does not fly.
pretty amazing. The discount has been sparked by concern that the wrapped Bitcoin is not fully backed, given that Alameda Research, the trading desk co-founded by FTX's Bankman-Fried, was once the biggest merchant to issue the offshoot. Executives at BitGo dismissed the speculation, saying via Twitter that all of the derivative is backed 1-to-1 by Bitcoin, held in custody by the firm. So if it's, so that means they've got it?
Yeah, but I think a lot of questions are raised today and in the last 3 weeks about companies that you give money to in order to buy cryptocurrency and what they do. And I'm not saying this, this exchange or this, crypto or anyone quoted in here is doing this, but I think consumers have different ideas now about what could happen given what happened with FTX and Alameda.
You've done a lot of reporting. I mean, do you feel like just there's more shoes to fall or what?
Absolutely. I mean, look at BlockFi yesterday. A little more than a year ago, I was interviewing Zach Prince, the CEO and the founder of the company, and he was flying high, more than $1 billion valuation.
Very different tone, and probably more to come. This is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Lots of earnings after the close of trading. CrowdStrike shares are plunging by roughly 18% after the cybersecurity company issued a revenue outlook for the fourth quarter that trailed the average analyst estimate. Software maker Intuit cutting its revenue guidance, shares down by roughly 2%. HPE, Hewlett-Packard Enterprise, projecting revenue for the current quarter that beat analyst expectations. We've got that stock up now by about 2.3%. Turned out to be a mixed day today. Stocks pared most of their losses. Traders unwilling to make big bets ahead of Jay Powell's speech tomorrow. We will have the Fed chair's remarks live for you here on Bloomberg Radio. The Dow ended the session with a 3-point gain, little change there. The S&P 500 index down 6, down 0.2%. NASDAQ today down 65, down 0.6%. A lot of weakness in tech names. 10-year yield 3.74% with the 2-year 4.47%. Spot gold up 0.5%, $17.49 the ounce. West Texas Intermediate crude rallied now by 2.1%, $78.89 a barrel. Briefly, TikTok now banned on government employee devices in South Dakota because the governor there believes the social media app's ownership by a Chinese company poses a national security threat. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you for that update. Well, our next guest involved in the crypto space, blockchain, and decentralized tech sector. He's an entrepreneur focused on the data digital economy, which, according to estimates, the digital economy accounted for 9% of current dollar GDP. That was 2018. That was some data points I came across. A lot and growing, Tim, no doubt about it.
We've got Michael Luckhoo with us, the co-founder of Cirrus Foundation, who joins us this afternoon from Miami. Michael, good to have you with us this afternoon. I got to tell you, Carol and I were chatting before the program as we were doing research into our guests, as we do each and every day. And I went to the Cirrus Foundation's website, and I got to tell you, I'm a little confused about what you are working on. So break it down for us and for our investing audience. Explain what it is.
Yeah, pleasure to be here. Thank you so much for having me. And yeah, I want to really break this down as simple as possible for our guests. And Cirrus Foundation, what are we? So we're a technology-based company powered by Web3 to enable people to take ownership of their data, which we think is their largest digital asset, and allow you, the creator of this data, to be paid from it and to enter new financial opportunities. So, you know, the reality is everything we do online is marked with value. So you're tied into all these platforms, whether it's Twitter, whether it's Facebook, and so forth, and that is a well of data. And all of that data is being pumped into advertising, into marketplaces. It's really a $1 trillion industry. The big problem with this, though, is that we're leaving the creator, which is you and I, out of the equation. And so we're basically flipping the switch on that to bring people back into the equation and have them earn from their one of their most prized assets, which is data.
Okay, listen, if I got paid to be on Twitter, my friend, I would be a wealthy man, okay? Because I spend way too much time on that platform, much to the detriment of like my thumbs, which hurt as a result of scrolling on my phone. The problem that I see, or the challenge rather, that I see with this, Michael, is you need the platforms to participate, don't you?
No, not necessarily. You know, on those platforms, they're already connecting and getting all that type of rich data. But everything you do online really forms a identity of who you are, a digital proxy of you. So as long as you're surfing the web, you're leaving bits of this sort of like digital footprint everywhere you go. So that is rich data. And that is rich data that really, in fact, you haven't really been a part of that value equation from. And so we're seeing a shift towards these abilities for brands to get a little bit more insight, which is called zero-party data, and moving away from these cookie tracking softwares. But at the end of the day, regardless of the platform, you should be able to access that because it is, in fact, your data.
I feel like we're talking a little bit in the abstract. So give me an example. Like, I'm curious, Michael, how many people are on your platforms? How many people are making money off of their own data, whether it's past browsing history, whether it's current browsing history, whether it's location details? Give us some numbers.
Yeah, we're actually getting ready to launch. We've been testing a lot of this for the past year and a half. We had an early set of users, around 25,000 users on our platform. And we were able to test it and see what the value is. The great part is because it's such direct insight of what the actual user is doing across the internet scape. Earmark is around $9 to $10 a month in this rich party data, but it goes further than that. The idea is that this asset is much more rich across the internet scape of what you do, but in emerging markets, that goes a long way. So in a household, that's 5 people, it could be up to $45 a month, and that pays for a lot of bills. You know, it's a surprising stat that even in the U.S. alone, that around 47% of people are not even able to come up with an emergency bill of $500. So every dollar counts, especially in the economy this day and age. So that's really what we're intending to do, and unlock a digital asset that already exists for you and put it back into your pocket.
Who's paying for it? So give me an example of who would ultimately pay to have my data or Tim's data or somebody from an emerging market.
Yeah, there's massive data market platforms out there. It's a bid and ask kind of marketplace right now, of which these marketers tie into. So ad revenue platforms tie into this, and brands buy this data. So they say, okay, I'm looking for the subset of users, whether it's this profile, this demographic, and they were able to bid on this. Live bidding actually happens. So this all happens behind the scenes, and people don't really know it's actually happening. So big advertising agencies and brands are actually buying this every day, every single day we're actually on the internet. And even more so now because they're so much more connected to the internet. So this is actually already happening. We're just tying ourselves into that equation. It's really a massive well of value. So that's the only thing. The people who have created the data have been left out.
Hey, Michael, one thing that we found over the last few weeks, and indeed months since the fall of Three Arrows Capital, is the way that so many firms in Web3, and I'm using that term as a broad umbrella term, are so tied together in a way that we didn't know they were tied together. We saw this with the implosion of FTX as well and the bankruptcies that have occurred since then. Do you at Cirrus Foundation have any exposure to FTX, Three Arrows Capital, or any of the projects or companies that have gone belly up?
Yeah, no, not at all. And this is what, you know, it's really challenging me. I've been in this industry for quite some time. And the philosophy around Web3 is around owning your data and owning your assets. So we had no exposure to this. This is, in fact, was a Web2 type of centralized company that had misappropriated people's funds and their assets. And that's gone completely against the grain of
You're
what
talking about
Web3 stands
FTX?
for. Correct.
And we should note that, you know, this hasn't been proven yet in any courts of law, but they have filed for bankruptcy.
Correct. Yes. And you know, the court filings will find what happens from this. But our philosophy is that these things would have been safeguarded in any event, because Web3 is around owning your assets and owning your data. And so that's a decentralized mindset. You know, some of the examples such as decentralized finance or Bitcoin really stand for that. We've had no exposure from that, and I think if people really lean into what Web3 really stands for, the charge is about owning your assets. And so we don't want to see bad actors come into the space and take advantage of the narrative. You know?
Michael, what's the stop of Google or an Amazon saying, okay, I get it, your data is your data, we'll throw you something, but we still want to be an aggregator of lots and lots of data. Just got about 30 seconds. So basically doing what you're doing, some of the existing entities that are out there, like I said, whether it's Google, whether it's Microsoft, whether it's Amazon or others.
Yeah, the reality is they've been built on big data. That's their business model. And I would find it very difficult to see that they're going to shift away from that completely. They've been built on tops of personal information and data. And to completely take them away from what their core business model has been built on, I find that hard to believe. I think the idea is, as we shift to more of a progressive digital economy, which is Web3, that large companies such as Facebook, Amazon, Google will have to compete for access to our data, and that's really the redefining how we use the internet. This is not something that's going to happen early. I think there'll be early adopters first, and then there'll be the kind of the unwilling followers.
Well, ownership of data is certainly a big thing and a big topic, and something governments are increasingly concerned about and looking into. Michael Laku, thank you, co-founder of Cirrus Foundation, joining us from Miami. Interesting. All right, we're headed, catching a plane.
Going to the airport.
West. Yeah, got some interesting shows coming up, everybody. Have a good and safe evening.